All right, well, the stakes are certainly high for Fed Chair Jay Powell, but what exactly is Wall Street hoping to hear? What tone should Powell be striking? Market strategists have been helping us answer that question.
Jay Powell is not going to really show exactly what they're going to do in September, although he may lean towards being more dovish than not.
We don't want any surprises. I mean, the markets have had a very strong comeback from that August 5th sell-off.
I think what he'll say is, you really should have listened to what I last said at the end of the last meeting, where I conveyed the sense of my colleagues. The economy has some momentum. Inflation is declining. That's welcome, but we can't put that in the bank.
All right, well, let's put that question to Brian Jacobsen. He is the chief economist and strategist at Annex Wealth Management. Brian, it's great to have you here. So certainly there is a lot riding, it sounds like, on Powell's speech tomorrow. What do you think? Is he going to be dovish enough for the markets, or is he set up almost just to disappoint investors?
Yeah, thanks for having me. Here at Annex, our investment committee, we've been looking at the history of what he has said at Jackson Hole and the evolution of his messaging since the last time that he appeared. And the market might be having too high of hopes for what he might actually say. In a way, expectations are so high, maybe he's actually doomed to disappoint. I really loved the reporting that you had at the beginning, going through some of that history in 2022, talking about how there will be pain was kind of his big message there. 2023 was about them trying to figure out when is monetary policy restrictive enough. Now, the messaging might be along the lines of, you know what, we can actually reduce the interest rate, the federal funds rate, without providing monetary easing, simply because inflation has come down. So they're really focused on inflation-adjusted interest rates. And as inflation has come down, that policy rate should also be coming down. So in a way, maybe it's going to be a little bit of a disappointment for people who are expecting a big message about monetary easing, because it's just about trying to keep policy from becoming more restrictive as inflation continues to trend towards 2%.
I mean, is that because of, and that set up for disappointment, is that because of over anticipation, or is it because of the reality that we're starting to wade into, where bad news is actually becoming bad news and good news is finally good news, I guess, here? What's your kind of calculus that you're running there?
No, you're absolutely right. Where it did look like bad news was good news, mainly because the bad news for the economic data was almost like saying something bad about the Fed. So bad news is always bad news, and good news is always good news. It just depends about what. And it's oftentimes about what is the Fed likely going to do as it relates to that data. So when we had really strong growth, that was good news. It was bad news for the markets because it meant that the Fed would hold rates higher for longer. Now it's a little bit different, that the Fed is poised to start cutting. But the problem is that sometimes rate cuts, you have what's called a J-curve effect, where when they start cutting rates, people might actually sit on their hands saying, let's wait for those rate cuts, for a few more of them, to make it actually make sense to borrow more money or to refinance a loan. Because it's not necessarily the first cut that is really going to help the economy. In fact, it could actually hurt by actually lowering the interest income that savers get. So the benefit takes actually months to be felt in the markets and the broader economy from those cuts. At first, there's a little pain.
So, Brian, what does that then look like for the setup here for growth? It sounds like it could be a challenging time here then over the next several months.
Yeah, that's our expectation, is that, well, we don't think we're going to be going into a recession. We've gone basically from great growth to good growth to sustainable growth. When you get those cuts, the market is pricing in a reacceleration of growth as you go into the fourth quarter. And there are lagged effects to the monetary policy where you might not actually see those benefits until maybe 12 months from now. So the fourth quarter, I think a lot of people have high hopes about a relief rally after the election, no matter who wins, from the rate cuts. Maybe the economic data isn't necessarily going to support that.
Okay, and so let's lean further into that strategist hat. Where are you kind of continuing to put your eggs in the market basket? Is there a certain sector right now that you're kind of overweighting and leaning into, anticipating what the Fed may do here?
There are. And from a sector perspective, we do like some of those cyclical names, like in more industrials, financials. That's more of a valuation play, and the idea that the market for those areas has already been pricing in a recession, because the market has been pricing in boom times for tech, but recessionary periods for some of those cyclical areas. Consumer staples is not necessarily cyclical, but it's another one where people were, I think, caught off guard with the reports from Walmart and from Target, even though Target is technically in consumer discretionary instead of consumer staples. It's a weird way that they do the classifications. But a lot of people have almost said, okay, well, we're going into recession. That's been reflected in some of those stock prices. Others, it's pricing in boom times. So we're looking more for where is a recession or slowdown already priced in. So industrials, financials, energy, those are a few of our favorite places as far as for fishing for opportunities in the sectors.
It's because we call them Target that they fall into the discretionary side of the equation there, Brian. All jokes aside, great to have you here with us this morning. Brian Jacobsen, who is the chief economist and strategist over at Annex Wealth Management. Thanks.